Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, August 14, 2018, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And so we had somewhat of a take back today, and a take back meaning yesterday was a down day and today was an up day. So we took back the down day. That's pretty much what happened. So we've basically had a couple of down days. We had an up day. We're still very close to all-time highs in the S&P and other markets. All we're doing is really going back and forth near the all-time highs. We're above all the moving averages. Technically speaking, there's nothing wrong with this market. I can make a case in two different ways, and then I'll tell you why neither is really important. I can make a case right now that we had a down move and that we're consolidating sideways in a bearish flag formation, and this is setting up for another down move. And that could very well be true. Now keep that in the back of your mind just for a minute. That visual I just drew of that bear flag formation. Now, I can also make a case that we had an up move and we're just consolidating sideways, going back and forth. This is a pullback pattern that generally will set up for another move higher. Maybe we pull back more, maybe we just go back and forth for a few more days, but either way, it's just a bullish pullback pattern, a bull flag pattern, a bullish wedge pattern. Call it what you will. Either way, I can make both cases, and guess what? The second case, what happens if this bullish pullback pattern, let me redraw it. What happens if it still was a bullish pullback pattern, but we went up, and you can even say we went up from here. Either way, it doesn't matter. And what happens if we went down all the way to down here? Okay, remember the 279.16? We talked about it last night. That's a line in the sand. As long as we remain above that number on a daily chart, closing basis, then the market is okay. It's in a bullish position. Below it, it's not a death sentence, but below it will turn the market short-term bearish. It will turn the trend short-term down. So if we want the trend to remain up, above 279.16 is important. So we could come all the way down near that number and still take off from that number and make new highs yet again. So that's why both scenarios can actually be true. I can have a bearish pattern and I could come down like this. I can make a bearish pattern. I can come down another leg down. This symmetrical bearish formation will be complete. Market symmetry from the top to the interim down position, and then the secondary down move here. Equidistant, market symmetry, measured move, call it what you will. That could happen, and from a short-term basis, we can complete that pattern, and yet I could still have the larger bullish pattern intact. And therein lies the reason why I'm not really going to hold much importance in either of those. What I am going to say is that there's technically nothing wrong with this market, that we're near the all-time highs, we're going back and forth. There's nothing wrong with this market telling me, and I'm going to show you why on other charts in a minute, but there's nothing wrong with this market or nothing telling me across other markets or within this market, there's nothing telling me that underneath the hood, that the internals, as they say, of the market are deteriorating. Nothing is telling me that. Let me show you what I'm talking about. First of all, let's go over to my favorite market leading indicator. Oh, before we do, I'm going to go back to the SPDR. Sorry to jump around. Let me show you the hourly chart real quick. By the way, before I do, let me pause and make mention that once again, I want to thank everybody for participating, making comments, and posting underneath the video. It's important information, helpful to everybody, helpful to me, and helpful to the entire community. The comments are helpful and they're thoughtful, and I really appreciate it. So please continue to do that each and every night. Please continue to participate. Also, hit the like button on the video and share the video with those people you think can benefit from this information. Okay, back to the charts. So on the spider chart, 60-minute, this is the hourly chart, what do we see? Well, we see an up move off the bottom from yesterday, and we're going sideways. What is the market telling us when we're going sideways? Well, more often than not, what we're likely doing is we're going up and then sideways to eat time off the clock. We're building energy to make another push or a continuation move, another push higher. In this case, continuation move higher. Now look at where we've been consolidating. And this is the thing. This is what you find in the course at Lazy E-mini Trader. It's things like this, right? And there's, dozens and dozens, if not hundreds of these things. I'm giving you little snippets here, but look what happened. So we have a breakdown candle. So here's the top of the breakdown candle, right? I talk about this all the time. No surprise. We rallied up to the top of the breakdown candle. And now we're just going sideways, making a bull flag pattern near the top of the breakdown candle to get through the breakdown candle. So we rallied up, we retested the top of the breakdown candle. Markets like to do what? Test the top of breakdown candles and bottom of break-up candles. Where have you ever heard that before? I don't know where I've heard that before, but I know I heard it somewhere, and that's what happened here. And then we're just going sideways to build that energy for a few more hours, maybe possible or maybe needed, and then therefore we can have that continuation move in the upward direction. So this happens on all charts, all time frames, whether it's an intraday, 10-minute chart, hourly, daily, weekly, monthly, doesn't matter. We point these different patterns across all different charts, all different time frames. So that's the spider 60 minutes. So the hourly chart leading into tomorrow from an hourly perspective is saying higher prices are likely. Now, the IWM, same thing on the hourly chart. It's very similar. It looks a little bit different, but not much. We're above all the moving averages in the hourly chart. We're basically just consolidating in this upper portion of this chart on the hourly chart, consolidating to have a continuation move higher. Let's go to the daily, because what's interesting on the daily is look what we're challenging. And what's interesting, and we just talked about it one more time. We talked about this last night. We talked about it the day before, the video before. Here's the top of a breakdown candle. Now, we've come up to test the top of that breakdown candle a few times already. We did it again today. We're threatening the top of that breakdown candle. This was an up day where the up day on the IWM had significant relative strength as opposed to or in comparison to the S&P 500, for example. So the spider was up about 0.6%. The IWM was up over 1.1%. That's relative strength. My favorite market leading indicator, once again, is telling us higher prices are coming. Again, not each and every day does the IWM have to be in lockstep leading the market in one direction or another. However, when it does, we want to note that. We want to make sure we're aware of it. It's a puzzle piece. It's a clue. We put it on the table. The more puzzle pieces, the more clues we have on the table, the faster we're able to assemble the puzzle, assemble the picture. As we're putting the puzzle together, the picture becomes clear. It becomes uncovered, if you will. It becomes unveiled, and that gives us a very clear visual of what the next major or likely move in the market that we're looking at is likely to be. And that's why we use the analogy of building a puzzle to see the picture clear. So why is that price level so important on the IWM? Because if we get above the high of that breakdown candle and close above there, it takes the bearish pattern off the table. The bearish pattern no longer exists, and the market will actually and likely release the energy that it would have otherwise released, and it may still release the energy in the downward direction. So we have a down move, we have a bearish wedge pattern. Likely story is, under normal market conditions, this energy will be released in the downward direction. However, if in fact we close above the high of that breakdown candle, that same energy will be released in the upward direction, And if you think that the IWM is going to go up alone, you're mistaken, because if that's going to happen, and that's a big if, it's an if, but if that's going to happen, the Spider, the Dow Jones Industrial Average, the NASDAQ Composite, all markets across the board and most stocks across the board will be amongst that rising tide that is giving a lift to all the boats across the markets. The transports. Similar transports in chart look or visual, similar to the Spider, I guess, in just the look of it, above all the moving averages. We've basically just had a pullback. Now, we were at recent highs in the transports. They're not all-time highs. Remember, they're recent highs. When we go to the weekly chart, remember what we have. We're up against, from a few months ago, we're up against the weekly highs. These are not the all-time highs. All-time highs were way back in January of 2018. So still, within this year, we had all-time highs, and we're now just really consolidating underneath that all-time high. Interestingly enough, this could actually be a pretty bearish pattern, but nevertheless, keep in mind that this chart is bullish. It's in an uptrend. So scratch what I said. I was just basically thinking out loud. What we have to realize is I'm looking at a weekly chart, and there's about 400 points between the 20-week moving average and where price is right now. And in between those 400 points is a lot of white space. And in between there are A, other support levels along the way, and B, a lot of space in which this market still remains in a long-term uptrend. So there's technically nothing wrong with this market, but it is interesting how right out of the course, the market rallies up for a specific period of time. And again, we could be looking at an intraday 10-minute chart, take the labeling in the middle of the chart away where it says DJT WK, that stands for week. We could take all that away. This could be a 10-minute chart, and I would be telling you the same thing. The market rallied for a specific period of time. This is outlined, taught, and discussed in the course at Lazy E-mini Trader. We put in a sign and a signal of a trend change. Here's what our expectations are next. We could do this. We could do this. What's interesting is that we could be having that discussion on any chart, any vehicle. It doesn't matter that it's the transports. It could be any stock, and it could be a 5-minute chart, and it could be a monthly chart. It's very fascinating how the market moves for a specific period of time, but it doesn't matter whether we're looking at a 10-minute chart or a weekly chart. Go chew on that for a while, and folks that have taken the course completely understand where I'm coming from with that, but it is a fascinating phenomenon how the market will move from a visual perspective. We can take all the labeling off the charts, put up any time frame chart, any type of chart we want, and you can never distinguish what chart we're looking at. All charts act and react the same way. And by the way, I've run that exercise. We actually do an exercise like that in the course, and it proves the point that it makes no difference what the label is on the chart. Here's a chart of the Qs. We're still above all the moving averages. Again, there's nothing really that changed between yesterday and today other than the fact that today was up and yesterday was down a little bit, but we're above all the moving averages. We're just going back and forth, and essentially all this is really doing is building energy, eating time off the clock. Nothing more, nothing less. The trend is still up. The trend is our friend until the very end. Nothing has really changed on the chart of the Qs. The XBD was up today. We had that down day yesterday, and I guess we can make a case that we had somewhat of a completion. I can make a case, I can plead a case that we completed the bearish pattern that was completed yesterday by having a down move, a bearish pattern, a bearish formation underneath the moving averages, and then a subsequent down move completing that pattern. I can plead my case one way or the other. It's debatable whether that finishes from a symmetry perspective, that move. But either way, We had an up day today. We had a down day yesterday. Did anything really change in the broker-dealer index? Not really. We're below all the moving averages. And from one day to the next, a trend is not made. So we can't really derive any new information on the broker-dealer index from today. And the flip side is the same on the XLF. Yesterday was a down day in the XLF. The day before was a down day in the XLF. Today was up a little less than 1%. There's nothing we can tell new. There's no new information in the XLF, just like the XBD. We're above a couple of moving averages. We're below the 20 moving average. We're in this upper range. We have had a tremendous move off the bottom from right around 26 and a quarter all the way up to 28 and a half in a relatively short period of time in the XLF. All we're doing, folks, really is working off some of that short-term overbought condition. Getting below all the moving averages, the 100 and the 50, getting back down to that $27 neighborhood. That may change things a little bit, but until and unless that happens, all this is doing, in my opinion, is working off some of the overbought condition. The SMH. Now, last night we looked at the SMH and we said, envision the SMH or envision the Qs without being top-heavy or lopsided with Amazon, Netflix, both Google stocks, one tracking stock, one other stock, Google, GOOG and GOOGL, and a couple of other stocks. Imagine without the top heaviness to the Qs, what would that index look like? Would it look more like the SMH or would it look like something else? Well, I guess we could theoretically run the numbers and figure it out, but I'm not going to do that. I don't have that kind of extra time on my hands. I know there's a couple of you out there that probably will run the numbers on that. And by the way, I don't begrudge you. I am fascinated when some of you come back with this data feed of information that boggles my mind in a very short period of time. I love the fact that you dig into the information because you're as fascinated with the information as I am, and you have a different capacity to go and plug and play with numbers using some programs that I frankly just don't know how to use. So, kudos to you. But nevertheless, I think the point is that the SMH has a high, a lower high, a lower high. Would the Qs look more like this than they do near all-time highs? And I contend that's more likely the case. We would likely have a scenario where we have an index with lower highs. Now, this is where we have to begin, or we have to just recognize that we need to always look at both sides of the market. In the short run, are we likely to have higher prices? Even if we pulled back, whether it's tomorrow, for a couple of days, or whatever, even if we pulled back first, I still think in the SPY and other markets as well, I still think we can make higher highs. Can we sustain them for a period of time? That's another story altogether. But I don't think we have to be done with the upside of the market. But what I do need for everybody to recognize is that underneath the hood, when you look at all the data that I look at on a regular basis, there really are problems underneath the hood of this market. The market is top heavy. There's a lot of, lawn chairs on one side of the boat, if you will. There's a lot of stuff going on. Everybody's going to run for the exits at the same time. There are issues underneath parts of the economy. There are credit problems. There is a student loan debt crisis. There are global problems. There are problems in Europe. There are other geopolitical issues around the world. Iran. I get what's going on out there. I mentioned it last night. Some of these will turn out to be nonsense. Some of them will turn out to be real issues that have a real impact on global financial markets. We don't know exactly which ones and when, but I just want to bring it to your attention that I am aware that when we look at the markets and take them for face value, you may see one thing, but when you look at the markets in other contexts, sometimes you see something else, and that's where we have to put all the puzzle pieces on the table at the same time, and you end up with a picture. You may not necessarily like the picture all the time. It doesn't matter what you like. It doesn't matter what I like. What matters is, are we getting the correct picture? So we look at the SMH and we say, yeah, when we pull back the curtain and we look at it from a longer term perspective, it doesn't necessarily look the same as the spider. I can make a case on the weekly chart. I can make a case this is still in an uptrend. I can also make a case for a couple of other things that may potentially be going on. I can make a case there's a long-term head and shoulders that hasn't triggered, and it could take months to trigger if it's going to trigger at all. It could take a long, long time to play out, months to years. But I can make a case that there's one in here that could be developing, or it could develop out of this weekly chart. So I can make a lot of different cases, a lot of different ways. And as analysts, that's what we need to do. We have to look around the world at a lot of different markets. Here's another heavyweight sector of the S&P 500, the XLE. So this is an ETF that comprised a lot of energy-related stocks, Chevron, Exxon, stuff like that, and other integrated oil plays and other energy-related companies. And so the question is, do you look at this and say, where are we trending? What does the daily chart look like? What does the weekly chart look like? Does it look like we're headed higher? Does it look like we're headed lower? I can make a case both ways. I can make a case this is a bearish pattern that's going to break down and come down to $70 to $71. And I can also make a case this is a bullish pattern that's building energy to make another push higher. And I can make both cases on the weekly chart. And whenever I can do that, there's nothing I can do with that chart, because when I can convince myself one way or the other or both ways that either one can happen, then it's a coin toss, and you might as well go into a casino and play something where you have around 50-50 odds, because that's all that would be. So I just move it along, and we'll look at a different index, a different sector in the market. Here's a technology select spider fund, and this looks very similar to the Qs. And when I look at this, I would say right out of the chute, it's probably top heavy, just like the Qs, so I'll move it along. Here's an interesting one. Here's the Select Spider Retail Sector Fund. So this is a fund comprised of retail related companies in the S&P 500. And what's interesting is this is telling you that the economy is healthy. This is telling you that the consumer, that you and I really are out there spending money. This is telling us that the consumer really did get a raise out there. The consumer does have more disposable income in their pockets, and they're spending the money, because if they weren't spending the money, and listen, let's face it, we have a consumer and service-driven economy. So without the consumer, the retailers would not be at highs. This chart would not be at a high. It's not just at a recent high. This is at an all-time high. So you have the retail sector at an all-time high. That's also telling you underneath the hood, at least right now, there's nothing wrong with the economy. So I can point to a chart that says lower highs are trouble long-term, but long-term could be months and months away. But I also can point to a different chart saying, hey, this chart's saying the U.S. economy is healthy, people are spending money, continue to ride the bull, your trend is your friend until the very end. I can make both cases. They're both picture puzzle pieces to put it on the table to form the picture. How about going across the pond and looking over to Europe? What do we see in Europe? Well, I'm sorry, the emerging markets, pardon me. This is the EEM, which is emerging markets. The emerging markets are telling us trouble. They're telling us growth does not exist in the emerging markets. Money flow is going the opposite direction out of the emerging markets, not into. Look at this. We made a peak, and the peak was made in January of 2018. We've basically been in a downtrend all year long. We're making a bearish pattern over and above the 100 period moving average, if we close, and this is a weekly chart, so any Friday close below $42.15 on the EEM, and there's lower prices coming. By the way, and again, something that's taught in the course at Lazy E-mini Trader, I don't know how many times I can beat the drum on this. Where did markets go? Markets went to come back and retest a former breakout area. The market rallied up, consolidated. That's the chart's way, or the market's way of telling us that this price level was important. We made a bull flag pattern, so we rallied up to this point. We found resistance. Charts telling us price is important. We broke out. We rallied all the way up to January of 2018, came all the way back down to do what? Test a former breakout area. All charts act and react the same way. Pretty fascinating, isn't it? But the EEM, the emerging markets, is telling us not so healthy. One of the last lines of defense before some additional white space exists in between the 100 and the 200-day, or pardon me, week moving average. So it's a make it or break it for the EEM. So when you look around the world, there are conflicting data points, no question about it. Here's consumer discretionary. Again, similar to retail. What's in the consumer discretionary? Again, take it with a grain of salt because it is lopsided. In consumer discretionary, I believe we have like 23% is Amazon. So again, that has to be taken with a grain of salt because Amazon is whatever it is now, $1,900 a share, some ridiculous number. But also you have Home Depot, Disney, I believe Comcast, Netflix, McDonald's, Starbucks. So their consumer discretionary are important companies, part retail, part stuff we spend our money on that we don't have to spend our money on. And retailers are doing fine. Consumer discretionary is doing fine. When those two indexes or those two sectors within the economy are doing fine, that has to tell you that the economy, the U.S. markets, and when I say markets, I'm referring to both the economy, the equity markets, the capital markets, the markets in general, capitalism in general. Markets are doing fine in the U.S. That's my conclusion when I look at all these different sectors within the S&P 500, in addition to all the other markets that we look at. Okay, I'm running out of wind here. We'll finish up with gold and then oil. So here's a weekly chart of gold. You know what? We don't need this anymore. I mean, look at this chart. This is some dramatic drop on a weekly basis. I mean, this is just some catastrophic fall. Wasn't that long ago. It was in April of this year that we were at a high of 1384, and now we're at 1200 as of today. Again, I can bring up the daily chart, but there's nothing to do here. You know, you can make a case that that's an exhaustion candle. It's on some volume. You know, you don't want to buy that against yesterday's low. That's fine. Or against today's low. That's fine. But, you know, it's not for me. I don't have a high volume reversal at hand. I need to see something more. I don't have to be in a gold trade. I don't really care what the symbol is of the thing that we're looking at on the screen, of the vehicle that we're talking about analyzing or trading. I don't care if it's gold, if it's crude oil, if it's IBM, if it's Netflix, McDonald's. I could care less. So I don't have to be in a gold trade. I'm just going to steer clear. There's nothing on that chart that tells me I have to be in to win. So the other one that we'll look at, or the last one we'll look at, is crude oil. And again, it's pretty obvious what we're doing. We made a run for the convergence of those moving averages up there, the red and the blue. 20 is the red and the blue is the 50-period moving average. We made a run for those today, spiked up to and through by a little bit, and then we fell away. We were rejected. So what you can see price is doing here, it's pretty apparent right now, is it's making a bear flag pattern. We had a down move, all right, and we're going sideways, and this is a bear flag pattern. What does this normally do? Yes, you know, of course, what it normally does. It normally resumes in a continuation move with another move down. You have a gap down here. You have a safety net down here with a 200-day moving average. That's where price is going. Another day or two of sideways bear flag patternness in this general zone, this general ballpark neighborhood down here. And you're likely going to go down towards this gap that comes in right around 64.5, 64.60, 64.50, in that neighborhood. That's what this chart pattern is telling us. Now, how important is the 66.80? Well, apparently it's quite important because we keep trading in and around that. It keeps acting as support for a long, long time on this market. Look how many times it's been support for this crude oil market, 66.80. It's not like we just put that trend line on this chart yesterday. It's been there for a long, long time. And with that, folks, I am at a win, so I am going to give it a wrap here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.